Banks play a crucial role in the functioning of any economy, as they are the primary institutions responsible for financial intermediation, lending and borrowing, and facilitating transactions. However, banks can also fail due to various reasons such as poor management, economic downturns, or unforeseen events. When a bank collapses, it can have far-reaching consequences for the economy and the people who have their money stored in that bank. It means that the bank is no longer able to meet its financial obligations, including repaying depositors. The bank may be declared insolvent or bankrupt by the regulatory authorities. The first step taken by the regulators is to freeze the bank's assets and take control of its operations. The regulators will then try to sell off the bank's assets to recover as much money as possible to pay back the depositors. In most countries, banks are insured by government-backed deposit insurance schemes. The deposit insurance scheme provides a safety net for depositors in case their bank fails. The amount of insurance coverage varies from country to country, but it is usually a fixed amount per depositor per bank. For example, in the United States, the Federal Deposit Insurance Corporation, FDIC, insures up to $250,000 per depositor per bank. If a bank is insured by a deposit insurance scheme, depositors will usually be able to get their money back up to the insured amount. However, if the amount of deposits exceeds the insured amount, depositors may only receive a portion of their money back. If a bank is not insured by a deposit insurance scheme, depositors may not be able to get their money back at all. In this case, depositors become unsecured creditors of the bank and will have to wait in line with other creditors to receive any money that is left after the bank's assets are sold off. The collapse of a bank can have a ripple effect on the wider economy. Banks are interconnected through a web of financial relationships, and a collapse of one bank can lead to a domino effect, causing other banks to fail. This can lead to a credit crunch, where businesses and individuals are unable to obtain loans, leading to a slowdown in economic activity. In conclusion, when a bank collapses, depositors may or may not get their money back, depending on whether the bank is insured by a deposit insurance scheme. Even if depositors do get their money back, the collapse of a bank can have wider economic consequences, highlighting the importance of sound banking regulations and risk management practices. Thanks for watching.